Good morning, everybody. Welcome to another cup of coffee in the neighborhood with Jennifer Richardson.
Morning.
So we got a couple things to talk about today. One of them is going to be impact lending through Movement Mortgage. I work for Movement Mortgage, and we just came up with this new kind of strategy in order to kind of change the game when it comes to mortgages and let people know that, you know, when you do choose to use Movement, that you're actually making an impact on your community. And another huge thing that we got going on is Movement Mortgage is schools that they built. I think they have like 10 right now, and they're trying to build 100 over the next few years. And Wilmington just got selected as the next site for a Movement school. So 2025, they're supposed to break ground here. And the Movement schools are great because pretty much all of the children's expenses are covered by uniforms, backpacks, books, and then obviously the teacher's salary is covered by the foundation as well. So I think it's just a phenomenal thing that's going on.
And is that's going to be a charter school? Is that
Yeah,
right?
it's essentially a charter school,
so awesome.
and they usually do about, I think, 300% better than the surrounding schools in the neighborhood and everything else. And they always kind of build them in, you know, some of the more impoverished communities in order to kind of give those people a leg up, which is just, you know, altruistic in nature, which is great. And then the other thing that we wanted to talk about is just there's a program that we also created called the Movement Boost program. And what the Movement Boost program is going to be able to do is it's going to be able to provide your down payment assistance for your FHA loan, because
Awesome.
you can probably, you know, tell me about like, hey, what's one of the main barriers to entry when it comes to buying a house?
Yeah, it's liquid cash.
Yeah, it's the down payment.
Yeah.
And you know, essentially what it's going to be is it's like a second that you get on your house, but you're only paying a higher interest rate on that second part of the mortgage, and it can cover the 3.5%, which is required for an FHA loan. And then if you want to, you can use a 5%, and that can cover another additional 1.5% of the closing costs.
Oh, wow.
So, I mean,
So you could ideally structure a contract in that you're writing the contract for the buyer, and then could you potentially request additional seller paid concessions?
yeah, you could cover, like, so for instance, you know, your typical, you know, closing costs are probably about 2%.
Yeah.
So you could have the 1.5% left over from the 5% Movement Boost program, and then you could just ask for, you know, 0.5% or 1% to cover the additional closing costs.
Which seems really reasonable. And Mark, I mean, in my mind, I immediately see that the client may potentially get a check at closing.
No, they can't.
Is that possible?
Yeah, the only thing that they can get back is what they put in.
Yeah,
so if
for
they put $1,000 due diligence back that we verified, they could get that
Yeah.
$1,000 back. So you can't ever make money on it, of course.
But in essence, being almost zero cash to close outside of inspection costs and appraisal, that's fantastic.
Yeah, I mean, even
really
the
nice.
appraisal you can get back.
And there are no limitations on geography there, so they can be in town, out of town. It's, you know, unlike a USDA loan where you have to be within that.
Yeah, and a lot of people like the USDA loan so much, but they're honestly probably the hardest loan to qualify for.
I've noticed that.
Yeah, they're a very difficult loan to qualify for because the debt to income ratio on a USDA loan is so low. Whereas this is an FHA loan, and depending on what your credit score is, I can take you to a 50% debt to income ratio or 55%, which means that you can actually afford a house right now because, as you know, the market is still high. And the other thing that we want to talk about is, you know, kind of the news. I was gone for a week, and then we just kind of had life happen for the last week. But the Fed did end up raising it 25 basis points. So that means that interest rates did go up. Last week, the consumer price index came out, and it was favorable, saying that inflation was actually decreasing. But then, you know, Friday, there was a University of Michigan study that came out that said, you know, per their calculations, it actually increased. So, you know, the market is just, everybody's still just riding a wave. And I feel like any sort of news that comes out right now just kind of terrifies the market, even if it's good news. I just think people are just so apprehensive right now.
Yeah. And Mark, when you say that rates go up, and I know you can't quote a specific rate for lender guidelines and such, but when you say that rates went up again, I think the general consumer, we understand that means that they're still about where they were, but I think the general consumer hears that rates went up and possibly thinks, oh my gosh, are they 8% now? But they're not tracking in that area, correct?
No, they're not. Well, on a primary residence.
Yeah, on primary residence.
Yeah, on a secondary home or investment property, I mean, they're probably around 8%, depending on the stipulations of the loan and everything else. But yeah, I mean, they're going up and down. I mean, I still think from, you know, if you look at what like Barry Habib, who is, you know, an economist that's been pretty accurate over this whole time frame post-COVID and everything else, you know, everybody's kind of expecting this time next year interest rates will probably be a percentage lower. Obviously, we're no, you know, fortune tellers, prophets, or seers of the future, but The other thing that he said, and I think you're already kind of going to talk about this too, is the amount of equity that people have in their homes right now. And I think you were talking about that you can actually kind of do an assessment on how much equity they have.
Yeah, definitely.
How does that work?
So what I do is, let's make believe that we're not in this industry and you're not tracking, right? You and Becca call me and you say, Jen, we think we've probably got some equity in our house. We've been in it for, a couple of years, year or two, whatever. We're not sure where we're at here, but we're considering a home equity loan or home equity line of credit. And that's one of the major questions that's asked is, what do you think that the value of your home is? And so what I do is I'll look at your home as if I'm going to list it and sell it, and try to determine, and a realtor's job, our job is not to determine value, that's an appraiser's job, but we can give you a reasonable ballpark of what it's likely to appraise for. And so get those numbers over to you, and then, I can run a net sheet for you or whatever, you can do that yourself, and show you that you have 100 grand, 150 grand, whatever it is. And then what I'm seeing most people do is that they are utilizing that as a home equity line of credit, where they don't have to pull, they don't have to utilize it, but they can just sit on it basically. Or they'll do a home equity loan and pay off some high interest debt, possibly purchase an investment property with that, or property for their children or whatever that might look like. So I'm getting that call a lot as prices are high. Folks that have been in their home for more than a year typically have a substantial amount of equity. So it doesn't necessarily mean you're selling your home. It just means you're leveraging the equity in your investment.
And the thing about a home equity line of credit too that people need to understand is you're not going to be giving up that 3% interest rate that you locked in back when interest rates were so low. So you're only going to be paying a higher interest rate on the actual money that you draw out via the home equity line of credit. And if it makes sense for you, it makes sense for you, right? So if it, if you're paying credit cards at 13% and then you get a home equity line of credit at 8-9%, then you just lowered your percentages by 5%, which makes sense. But it's ultimately going to be one of those things if it makes sense or not to you. And a lot of people, what they do, especially around our area, is they'll use a home equity line of credit in order to go buy a condo, because now you're paying, it's a cash deal at that point, right? And a lot of the condos in our area, you can't get a conventional like standard loan on them, because unfortunately a lot of the condo complexes in our neighborhood, in this area, they don't carry enough flood insurance. So that's just like a death blow when it comes to
Or
a
they're
regular
owned by
loan.
one entity, over a certain percentage, which I see a lot, especially near the university. So.
But even then, there's non-QM products that we can kind of utilize for those, but still, if they don't carry enough flood insurance, or if they don't carry enough insurance to cover, 80%, I think it is, then it's done. So a lot of people do use the home equity lines of credit, and I think, it's the beach, like you can make quite a bit of money off an investment property in a condo down at the beach. I know a lot of people that do it. They're making, especially during the season, they make quite a bit.
For sure.
And then lastly, I think you were mentioning about like the new construction and comps and everything else. This is neighborhood specific. Are you seeing that new construction kind of is driving down the existing construction's comparables, or is it about even?
That's kind of a loaded question. I would say that you've got a lot of variables within new construction that when you're looking at values and pricing, the major thing that I see, the major variable would be upgrades. I've seen some folks put $100 grand in upgrades in a house. It's a lot, and beautiful homes for sure. But comping the same exact floor plan and seeing those anomalies within the pricing is, it's kind of a mystery. But we've got ways to work around that, of course. But I think that as far as like new construction, are they driving down prices? We're seeing an inventory increase, and new construction is taking, they're participating in that. So with, more inventory, of course, decreases a little bit of demand. And so we're starting to see things kind of level and chill, not necessarily drop, but just sort of level and chill. So
you're seeing the market actually kind of get back to like a norm.
Yeah, we're slowly getting there with inventory levels and days on market.
Things are just getting back to normal.
They're getting back to normal, which they need to.
Yeah, which is good.
Yeah,
I think normalcy is pretty much good for everybody.
I agree.
All right. Well, hopefully that was informative. If y'all have any questions or y'all need any help with any of the things that we talk about, just please shoot us a message on social media, and we're pretty good about getting back to you. And then, of course, you know, if you would like to see how much equity is in your house, Jennifer's always available to run some comps to be able to see if that makes sense for you or not. And then you can always talk to me about a home equity line of credit. So if it makes sense, we'll do it. And if it doesn't make sense, I never advise for my clients to do anything that doesn't make sense for them. So, but other than that, I hope that y'all have a fantastic week, and we will see you next